AM webinars. Thank you so much for logging in today, and thank you so much for having me and taking time out of your busy schedules to learn a little bit about the power of ink. It is a topic that is near and dear to my heart as a corporation owner, as a tax advisor. My spouse is self-employed and has her business running through an 1120S corporation, and I assist personally hundreds of clients on a year-to-year basis with their S Corp, LLC, and C Corp tax filings. Our firm as a whole, probably in the 7,000 entity range that we prepare nationwide. So today we're going to talk a lot about the power behind utilizing an entity or a shelter, like we in the tax industry like to refer to it as, to help retain your wealth. I mean, that's to be real frank with you. It's all about retaining your wealth. It's all about figuring out ways for self-employed income to pay less tax and for you to actually keep more of the profit. I mean, that's plain and simple. So today's topic, the power of ink, tax savings during times of economic uncertainty. My name's Anthony Watson. My friends and my family members, coworkers, clients call me Tony. I've been doing this for 18 plus years, working in the tax industry. I am not only the keynote speaker for our firm, but I absolutely practice what I preach. I'm a full-time tax advisor here at the firm. Individually speaking, I service roughly about 1,200 tax returns per year. My individual client column probably ranging in the $500 million in managed real estate and other small business dealings. And I also speak at over 140 events per year. I love educating people about the power of tax planning, the power behind incorporating, and just general tax topics as a whole. Our marketing division is about 13 or 14 years old. I've been doing this once again about 18 years. And I find that our marketing department, through our educational webinars, have really been able to help people and kind of guide them through the messiness of converting a sole proprietorship to an entity, and why you might want to do that, why it might not be the right time for you to do that, and what are the milestones that you need to hit before taking those next steps. But it's all about advising to navigate the rough waters of the tax industry, because let's face it, the tax code changes. It used to change every year. Now it seems to be changing every other week. After the Inflation Reduction Act back in 2018, we had the tax reform, the 2018 tax reform bill under the Trump administration. So there's been a lot of changes. And then we had the pandemic and all those changes. So we're going to talk a lot about in detail why an incorporated entity might be right for you. By no means am I a one-man operation, though. I work alongside a wonderful senior consulting staff. We're about 55 employees strong in the Southern California area, and we do file taxes in all 50 states. So if you are in need of consulting, if you're in need of help with tax filings, we are readily available to assist with all of those needs. Our firm as a whole, we've been around since 1971. We're by no means a pop-up shop. We're a very well-known name in the Southern California area, specifically and especially in Los Angeles County. We've won a couple of awards over the years. I think just recently we won Best Accounting Practice in the San Gabriel Valley, which we're in the San Fernando Valley. So I don't know how that happened, but we did win that award, which is pretty nice. And we service roughly about 10,000 tax filings per year here as a firm. But like I said, we've been open for quite some time. So our net client worth well into the $1 billion range. So we do see a lot here at Robert Hall & Associates. We're a one-stop shop for all of your financial needs. We offer obviously tax preparation services. We do also incorporate our clients so we can start the S Corp, the LLC, the C Corp structure. But most importantly, let's plan ahead to make sure that that's the right direction to go in, which we're going to talk about today. But we do financial planning, bookkeeping, you name it. We're like a one-stop shop for all of these services. And before I forget, I will mention this at the end. We do offer free consultations for new clients. This is 30 minutes either in person or over the phone. We suggest that you send us 2 years of tax returns for us to review those returns. If anything needs to be corrected or amended on those returns, we'll absolutely suggest to go ahead and do that. If you're not looking to onboard with another accounting firm, at least utilize the free consult to have a second set of eyes on what's been filed in previous years. I know clients who have been with Bob Hall since the beginning of time, it seems like, since 1971, right? And they're not looking to change firms, but shoot, I would absolutely suggest for them to have our work reviewed. If you had a free review with another accounting professional, to have that review just to see how the work is done, right? And to see if there's anything that could be missed. But I doubt that we've been missing anything on these returns. So, but feel free to utilize this free consultation for that free second opinion, just to review what's been filed for you in previous years. Without further ado, let's talk about why incorporating might be right for you, because this question alone is probably the most important question for a self-employed individual, a small business owner, to ask, not every 5 or 10 years, but to ask yourselves on an annual basis, is now the right time to incorporate? I call this initial consultation the interview process, because I need to interview the client to make sure that, hey, if I do suggest to incorporate, what are the key benefits that the client is going to receive? And so I need answers to 3 very important questions right out the gate. Number 1, what personal assets do you own? Do you own a primary residence? Do you own rental properties? Do you have inherited assets? Do you have large brokerage accounts, large retirement accounts? What specifically do you own personally, as far as assets are concerned, that are attached to your primary Social Security number? That's one thing that you, all of you in today's webinar, and myself and all of my associates and every taxpayer across the US, that's one thing that we'll have in common, is an identification number that is attached to our personal assets. And the number 1 benefit of incorporating, this is why this is question 1, the number 1 benefit of incorporating is asset protection. So the main goal here is to take this entity structure and separate your business revenue streams and your business assets, and separate those from your personal assets. So asset separation equals asset protection, and vice versa. The more you can have your assets separated, the better protected they are. So question number 1 is, what personal assets do you own? If you tell me that you own the primary residence, you've got the rental properties, you've got inherited assets, big brokerage accounts, then we check yes to box 1, to question 1. You do own personal assets. Question 2 is, what is the consistency of your net profit on a year-to-year basis? Because before sending you out into the world as a newly incorporated entity, we need to make sure that you are hitting certain net profit or net revenue milestones, so that incorporating will save you more than it's going to cost you on an annual basis. And we'll talk about the costs in a couple of slides here on an annual, rough average of costs on an annual basis. We'll dial those in, but we need to make sure that you are hitting a milestone figure of at least $40,000 to $45,000 minimum. And this is not gross revenue. So this isn't what you're going to see on your 1099s or what your gross deposits are. We need to figure out, after all of your expenses are taken into account, your IRA contributions, your car purchases, your equipment lease expenses, your airfare, your lodging, legal and professional fees, E&O insurance, after all of those expenses are deducted, are we hitting that $40,000 to $45,000 net profit milestone? And if you are hitting that pretty consistently over the past year to 2 years, then incorporating actually would make sense for you, not only from an asset protection and asset separation standpoint, but also because at about $40,000 to $45,000, the savings under a specific type of entity, and we'll get to that in a second, will save you more than what it's going to cost you on a yearly basis. So financially speaking, we as tax professionals, not only our duties are to file your tax returns, but we need to make sure that financially speaking, we're not putting you in a bind and tying you into these contractual agreements with the state agencies, with your accounting professionals, to where you're paying thousands of dollars a year to operate as a corporation, and it's not saving you more than those annual costs. So that's question 2. What is the consistency of your net profit, and are you hitting that milestone net revenue figure of $40,000 to $45,000? Last but not least, question number 3. Normally question 1 and question 2, if they check yes, then we can move forward with the incorporating advice and setting up the structure. But I do like to go over question 3 as well, because let's say, just for argument's sake, that you said, no, I don't own any personal assets. No, I am not hitting those milestone net revenue figures. Question 3 is about risk and liability. In your specific industry, do you tend to run a higher level of risk and liability because of the properties that you're dealing with, because of the type of clients that, or tenants or clients or customers that you're dealing with? Or is it just your industry as a whole that tends to run a much higher risk level or liability level than other industries? I'll give you a very unique example. I do taxes for a skydiving instructing business. I use this example in every single webinar I give. And when I first met with this skydiving instructor who had just recently bought a plane, he was an instructor. He had well over, I think, like 10,000 hours of flying. I mean, he was probably overqualified for this job, and he probably should have been flying private jets for Netflix or something. But he really wanted to teach people about skydiving. He was an Army vet, and he was one of those I forget the name of the soldiers that jump out of the planes, the parachute guys, the very brave soldiers, actually. And he was a vet, and he wanted to start this business, and he wasn't really hitting any net revenue figures yet. He didn't really have any personal assets except for the plane, but we incorporated his business simply because he has a much higher level of risk and liability in his industry than in other industries. So we started him off as an LLC just to protect the plane and to protect himself moving forward as he started to generate more revenue. But that's a very unique example. So once again, question 1 and question 2 normally suggest for us to move forward with the incorporated entity if the yes box is checked. But if you work in an industry, or if, let's say, your spouse, let's say that you are the real estate professional or the rental property investor, but your spouse is the one that has a self-employed business that might not be making revenue or hitting milestones, but there is higher risk levels of liability and risk. We might want to incorporate that person simply to protect them moving forward. So keep that in mind. And this is why it's so important to have this conversation with a tax advisor, with a legal advisor, with anybody who you trust with your financial and wealth management world. From an advisory standpoint, you want to be open with this conversation and kind of get ahead of the curve on everything. So let's say that we check yes to all questions, all 3 questions. Obviously, moving forward, we're going to set up the entity structure. And what options do you have as far as entity structures are concerned? Because obviously the general public knows about the LLCs. Some of you might know about the S corporation. Some people know about the C corporation. Which entity structure is going to be right for you specifically? Well, I can tell you right now that anybody who is a self-employed real estate professional earning commission income has seen on their return that at the end of the year, whatever that profit is, you end up paying federal income tax, you pay state income tax, and then you also pay this nasty 15.3% of self-employment tax. That 15.3% self-employment tax is also known as Social Security and Medicare tax, or your Social Security and Medicare obligation. So you're not necessarily paying 15.3% of additional tax and losing that completely. You're just paying into the social pots that we will all essentially collect from down the road, right? Because everybody has to pay into Social Security and Medicare on self-employed earnings and or W-2 compensation. So once again, as a self-employed individual, you see all these taxes that you're paying, and you're wondering, is there anything else I can do to further reduce or help me shelter some of this hard-earned revenue that I've built for myself and this revenue stream that I have for my self-employed business? Well, let's talk about the different entity structures and which entity structures could actually save you tax and which entities really just provide greater asset protection. The most commonly used entity out there in the financial world is the LLC. The limited liability company is great for doing exactly what its name specifies, right? It's meant to protect you from potential liabilities and risk. That's why it's called the limited liability company. I want to tell you this right out the gate, though. The LLC saves you absolutely nothing in income tax. LLCs are only for liability protection. That's why they are the go-to entities for protecting rental properties, whether it be residential or commercial, or if you have, let's say, an IT company, a tech company, and you have hundreds of thousands of dollars in server equipment, you'd want the server equipment and maybe the building that you operate out of under the LLC, because that's what the LLC is meant to do. It's meant to create greater liability protection on large depreciable assets. So the LLC for you self-employed individuals is not going to save you any tax. It's only for liability protection. Now you're telling that, let's say you're sitting on the other side of the screen, you're saying, well, Tony, can't I have both? Can't I have the liability protection and file as an entity that also saves me income tax? Well, yes, you can actually have the cake as well as getting to eat it too. And that's my boss, Bob Hollows, used to say that. It's like having your cake and getting to eat it too. I remember that, 18 years ago, him saying that time and time again with clients. The LLC doesn't have to file as an LLC. If you're self-employed, the LLC can be in place for liability protection at the state level. And then when you come to your tax advisors, we can make an election with the IRS to file your LLC as a different type of entity that would actually save you income tax. So for those of you who have already started an LLC and you're thinking, well, now, Tony, you're telling me I set up the wrong LLC. Don't worry. We can actually convert that LLC into a different type of entity that might actually end up saving you tax while keeping that great liability protection benefit in place. So that's the LLC. No tax savings if you just stay as an LLC. Let's talk about the C corporation really quick, and then we'll get to my favorite entity, which is the 1120 S corporation. The C corporation in the tax industry is known as a double taxed entity, meaning that if you have $100,000 of profit that comes in through your business and you've spent all the money that you need to spend for the year, and you've got that 100 grand in net profit sitting there. On $100,000 as a C corporation, known as a double taxed entity, you not only pay corporation tax at 27% federal and 9.3% state on whatever that profit is, but then whatever you take as a dividend or a payment to yourself, you pay tax on the individual return as well. So most individuals, most of our clients won't opt for the C corporation unless very specific and unique scenarios are in place for that client. They won't choose the C corporation because they don't want to be double taxed. I'll give you a very unique and specific scenario as to where you might choose the C corporation over an LLC or an S corporation, which is once again a very unique and specific scenario. For those of you who might have a loved one, either a child or a parent that you're taking care of and claiming as a dependent on your return, you might have extra or excess medical deductions for that individual. Let's say that you have an elderly parent that you're paying for, in-home care for. In-home care can range anywhere from $2-3 grand a month up to sometimes $10,000-$15,000 a month. And some of it might be covered by Medicare or by insurance, but a majority of it is pretty much out of pocket, and you're having full-time care for this loved one. Under an LLC and an S corporation, just to note this, LLCs and S corps do not allow for 100% medical write-offs. They only allow for your health insurance premiums to be dollar for dollar tax deductible. But as far as out-of-pocket medical costs, LLCs and S corporations do not allow for that write-off dollar for dollar. In fact, if you're an LLC or an S corporation, you have $100,000 in medical costs, the first 7.5% of your adjusted gross income personally is not even a medical write-off. So there's a major limitation on the personal return on the personal side for medical if you're an LLC or an S corporation. However, under a C corporation, if you claim this person as a dependent on your personal return, if you technically pay for more than 50% of their annual support and costs, then technically they are a dependent of yours, and the medical write-offs, because they are a dependent, would be dollar for dollar tax deductible under a C corporation. So if you're spending 60, 70 grand for in-home care for an elderly parent, it might be better for you to be set up as a C corporation if you're claiming that parent on your individual return as a dependent, because you'll be allowed a $60,000 write-off on the C corporation return. That is a very, very unique scenario, and that's probably the only reason why I would ever suggest for a self-employed individual to file as a C corp is if one of those specific scenarios was in play. C corporations are normally entities for larger corporations like the eBays, the Starbucks, the Amazons of the world, the companies that have over 100 shareholders. They have billions of dollars in revenue, specifically publicly traded companies. They normally are going to file as C corporation, and maybe they have subsidiary entities that are LLCs and S corps, but the main corporation is always going to be that C corporation structure. So that's LLC and C corp. Now for kind of the unicorn entity of the tax industry. I have a daughter and her room's full of unicorns, these mythical creatures, and she loves them. So that's the best way I can describe the S corporation, is that it is truly the holy grail of tax shelters. It is the only entity that has proven time and time again to actually protect assets separately from personal assets, so protecting your business separately from your personal assets, number one. And number two, to actually significantly reduce the tax obligations that you pay on an annual basis as a self-employed individual. So how does this work? The S corporation gets to play some very unique games when it comes to internal revenue code and filing, which we're going to break that down in a couple slides here. But I just wanted to whet your palate really quick to show you that out of these three entities, the S corporation really is the only proven entity to help save tax. And like I said, we're going to dial in a calculation in a second here. I had mentioned just a couple minutes ago about converting an LLC or even a C corporation to an S corporation if you are already set up as that type of structure, but now you realize, well, maybe that's not the right type of structure for me. Don't worry, you don't have to shut it down and restart a new entity. When you come to your tax advisors, we can take your LLC and or a C corporation, and we could file something called a 2553. It's a form, an Internal Revenue Service form. And that 2553 form is what's called an S election form. So you are electing to file your LLC, but taxed as an S corporation. You're electing to file your C corporation as an S corporation or be taxed as an S corporation, even though the original articles of incorporation stated that you were a C corp or an LLC. So don't worry, you don't have to shut it down and spend all this money reincorporating yourself. We can actually convert those two types of entities into an S corporation if it makes sense to do so. So keep that in mind. Now, before I jump into the dialed in numbers on the S corporation side, I did also want to mention for some of you who might be thinking, well, I have a great insurance policy. I don't need an entity structure. The insurance is going to protect me no matter what happens. Or I have a living trust. I don't need an entity and I have great insurance. I don't need any of these LLC, C corps or S corporations. Well, let's break down the differences between these three things really quickly here. You see three doors in front of you, right? The insurance policy is by far the most important thing for us to have because insurance is there and in place to pay out settlements in case an unforeseen event happens, right? We pull out of our driveway in the morning and somebody's speeding down the road and they sideswipe our car. Well, we have car insurance. They have car insurance to help us fix our vehicles and go about our day, right? We have health insurance in case we get sick or are hospitalized, right? So we have insurance and it is there and in place to pay out settlements or cover costs in case an unforeseen event happens. The LLC, S Corp, and C Corporation structure on the very far left door here, that does not have a payout value. It does not cover costs in case you're in an accident. It does not cover costs in case you get sick, like insurance does. It doesn't cover the costs of errors and omissions lawsuits. So just understand that the insurance actually has a payout value at the end of the day, whereas an LLC, S Corp, or C Corporation merely separates personal and business liability. So if somebody was coming to pursue you in litigation in a court of law, let's say, and they were pursuing you personally, technically what they're doing is they're not suing you, they're suing your social security number. And they're coming after everything that is attached to your primary social security number. So imagine this, if you can have 10 rental properties set up under 10 different LLCs, and each LLC has its own individual identification number, if they are suing you personally, they would also have to sue all 10 of your LLCs to pierce those corporate veils in order to come after each of the individual assets. It is very costly to do that, number one. Number two, it's very difficult to pierce a corporate veil, even in the state of California, a very litigious state, probably the most litigious state in the US, in fact. It's still very difficult to pierce that corporate veil. In fact, in a court of law, in order to pierce a corporate veil, whether it's an LLC, C Corp, or an S Corporation, they have to prove without a doubt that there was illegal activity involved, malpractice, or negligence. Those are the three main factors when piercing a corporate veil. And they have to prove it with evidence that you neglected, that you were in breach of malpractice, or that you just completely were part of an illegal activity of some sort, or operating an illegal activity out of your rental property or out of your business building, whatever you're doing. And that would pierce that corporate veil. And then they could come after the assets in that entity. I'm not telling you that if you have 10 rental properties, you should have 10 LLCs. This is a conversation you need to have with your tax advisors and your attorneys before jumping through those hoops, okay? But the LLC is there to separate business and personal liabilities. The living trust is not meant to give you the benefit of an entity structure. It's not even meant to give you the benefit of an insurance policy. The trust kicks in a benefit when one major life event happens. 99% of the time, that major life event is death, right? So the trust is really meant to protect your assets from probate in whatever state you file in. It's meant to protect your assets, your legacy assets, for your beneficiaries. Hence the name beneficiaries. The benefit goes to your heirs, right? So the proper structure as you build your wealth, as you build your business, the proper structure here would be to have your insurance policy covering your business owned under an entity structure like an LLC, S Corp, or C Corp. And then the owner of your entity structure is not you personally, it's the living trust. And that way, if heaven forbid anything happens, insurance kicks in and covers what it needs to cover. If somebody sues you in a court of law, you need the entity structure to give you that added layer of asset protection. And shoot, heaven forbid anything happens to you and you pass on to something bigger and greater in the afterlife, the trust is there to protect you from probate in whatever state you hold assets in. So this is, as you build your wealth, these are the things that you want in place for yourself, for your heirs, just to protect you at all angles. Now, some of you might be thinking, well, if I incorporate, is it best to incorporate from a liability perspective, from an asset protection perspective in California, or should I incorporate elsewhere in the US? And then we'll get into that calculation that's really fun to calculate for the tax savings. Incorporating in California is pretty straightforward. You file articles of organization or articles of incorporation with the Franchise Tax Board, and then you tie yourself into a contractual agreement with the Franchise Tax Board each year to not only file a return in the state of California, but also to pay what I call a parking ticket for parking your business in the wonderful state of California. That parking ticket is a minimum $800 filing fee every single year. Whether you lost money, broke even, or made profit, it's a minimum $800 filing fee to the Franchise Tax Board every year. And now you understand why I call it a parking ticket. It's literally a fee. It's not a tax. It's a filing fee for operating as an entity in the state of California. So you're thinking, well, $800 is pretty high. Well, yes, you're absolutely correct. $800 is the highest filing fee in the US across all states, okay? So you're thinking, well, why don't I just incorporate in Texas or in Nevada or in Florida where there is no state income tax? Is that a benefit for me? Well, California and New York, two very unique states, two of the highest tax state in the US. California is one of about 8 states that taxes its residents on their worldwide income. So you can incorporate in Texas, you can incorporate in Nevada, you can incorporate in Florida for greater asset protection benefit, but not to avoid California income tax or the California filing fee, okay? Because technically, if you are a California resident, if you register to vote here, if you drive around a car with California plates, if you have a California address on your driver's license, by definition, you are a California resident. And so if you have an entity in Texas or in Florida or in Nevada, and you want to play by their rules and avoid California state income tax, you have to register to vote in Texas or in Florida and Nevada. You have to drive around a car with those states' plates. You have to have a state address on your driver's license out of those states in order to claim residency in those states. Okay, so California is very unique. They're going to want to collect that $800 filing fee, whether you're incorporated here in California or elsewhere. The way that you would file that is if you wanted greater asset protection, like Delaware and Wyoming and Wisconsin, Florida, Texas, Nevada, great asset protection laws for business owners. But once again, you're not going to get that tax savings benefit. But if you do file your entity in one of those states, you incorporate there and your jurisdiction is Texas in this case. But in the state of California, you have to file articles showing foreign jurisdiction in the state of California. So you are a Texas corporation doing business in the state of California. Your tax advisors, your attorneys can assist with all of these filings. It does get kind of complicated, but for instance, my next 2 appointments today after this webinar, they both have entities outside of California. They both reside here in California, but for greater asset protection benefits, they have entity structures in Texas, in Louisiana, in Florida, in Nevada, and in Georgia and Delaware, if I didn't mention Delaware. So they have entities in all of those states. And the reason why they have those is because the state asset protection laws are greater in those states than they are in California. Though that's per the advice of an attorney, by the way. That's not per the advice of an accountant. I'm not a legal advisor. I don't want to overstep or step out of my lane of expertise. But the attorneys thought it would be best for these clients to have their entity structures in those states. The clients still fully know that they have to pay California's filing fee at the end of each year as a foreign jurisdiction filing to the state of California. So keep that in mind if you are thinking about incorporating. Now, let's jump into the wonderful world of S corporation filing. So like I mentioned, when we talked about the 3 entity structures, the LLC and the C corporation save you absolutely nothing in tax. But this holy grail kind of unicorn entity of the tax industry, the 1120 S corporation, plays by a different set of rules, okay? Let's say, just for argument's sake, I'm going to map it out as an LLC, and then I'm going to map it out as an S corporation. As an LLC or even sole proprietorship, if you have $100,000 in net profit, so this is after all of your expenses are taken into account. Let's say you've got $100,000 in net profit. As an LLC or as a sole proprietorship, you're going to pay federal, state, and self-employment tax on the full $100,000. Well, self-employment tax alone is 15.3%. That's over $15,000 in you contributing to Social Security and Medicare. That's as a sole proprietorship or an LLC, because LLCs pay the same tax as you individually. There's no tax savings benefit. As an S corporation, let's say the same scenario applies. You've got $100,000 in net profit, and now you are filing as a subchapter S corporation. S as in Sam, S corporation. Now you are no longer technically considered to be self-employed, right? You are now an employee of your own corporation, and employees receive W-2 compensation. So you are required, and to be real honest with you, this is actually where the benefit lies. So when I say required, this is actually a good requirement under an S corporation. You are required to issue yourself a reasonable salary of no less than 35 to 40% of your company's net profit. So let's use 40% in this case. 40% of 100 grand is $40,000. That's your W-2 compensation out of your subchapter S corporation. Then you've got $100,000 minus the $40,000 W-2. So your company has a leftover profit after you deducted yourself, you deducted your payroll of $60,000. So 100,000 minus the 40 grand leaves you with $60,000 in leftover profit. What you are achieving in this scenario is proper tax avoidance. Not tax evasion, because tax evasion is illegal. Proper tax avoidance is not. So we all need to figure out creative ways to avoid tax, not evade paying tax. So why would you want to go through all these, jump through all these hoops to split the 100 grand into these two numbers? Well, if you have a $40,000 W-2, this $40,000 compensation plan for yourself is subject to federal, state, and payroll taxes. Payroll taxes is Social Security and Medicare, only on the $40,000. On the $60,000 that's left over as flow through profit, that 60 grand is still subject to federal and state income tax, because no matter how much you separate the 100 grand, when you add the two numbers together, it still adds up to 100 grand, right? So you still pay federal and state income tax on both the 40 grand and the 60 grand. But what you avoid, not evade, what you avoid paying on the $60,000 amount is the 15.3% of Social Security and Medicare tax. 15.3% of 60 grand alone is about $9,200 in tax savings. This is just one benefit right out the gate of filing as a subchapter S corporation. This doesn't even include renting back the in-home office space to your corporation and taking depreciation and allocated mortgage interest and property taxes and insurance and all of these other things with depreciation to help offset rental income that you're technically charging yourself. And as you do that, if you're charging yourself rent to the corporation to rent out space inside of your own home, you are reducing the company net profit, right? Because you're paying, let's say, 15, 20 grand of rent to yourself. That's a deduction through your business, which then reduces the net profit and in turn reduces the reasonable salary payout and helps you shelter more overall income tax. If your eyes are rolling back in the back of your head, don't worry. This is something I do day in and day out as a professional for the past almost 2 decades. But if some of these things are turning on lights in your head and you're thinking, wow, that this actually makes sense. I do have space inside of my home. I don't want to file that highly audited in-home office form. I actually would much rather rent space for myself and file a Schedule E rental property form, which has less than like a 0.1% chance for audit, as well as paying myself the reasonable salary. I mean, shoot, just on 100 grand in profit alone, you're looking at well over $10,000 to $12,000 in overall tax savings simply by just filing as an S corporation versus a sole proprietorship or an LLC. Now, before we go on, I want to talk about some of the costs, right? Because we mentioned in the very first slide today, or the informational slide, that we need to make sure that the incorporated entity is going to save you more than it costs you, right? Well, if you're not incorporated, you just pay for the individual filing fee with your tax preparer, and that's it. That could range anywhere from $400, $500, $600, $700+ depending on the complexity of the return. When you add a corporation to the mix, you're looking at an average preparation fee of about $1,000 a year for the corporation, and then you have to run payroll. So you're going to have payroll costs. So let's say industry average just to operate a corporation is about, $2,500. That includes the consultation fees, the payroll processing fees, the corporate filing fees, and the individual tax preparation fees. Let's say it's $2,500. Well, the way that I came up with, or that our firm came up with, the $40,000 to $45,000 net profit milestone that we discussed earlier, is that at about $40,000 of net profit, The corporate entity structure, by playing this reasonable salary game at a $40,000 net profit, it's going to save you about $6,000 in overall tax on $40,000 of net profit. Well, if it's going to cost you $2,500 a year annually to file as a corporation, but it's going to save you $6,000, you're not only saving enough to cover the cost of incorporating, but you're also retaining a little bit more of your wealth. And that's only at $40,000 in net profit. But once again, there's a lot more paperwork involved. There's mailings that come to your house. I mean, there's a lot of processing involved, processing steps each year, which 90% of it, 95% of it lands on your tax advisor. But we need to make sure that it's going to save you more than those annual costs that you'll incur, about $2,500, let's say. At about $40,000, that's when it really starts to make you more than what it's costing you. You're saving more, a couple grand more than what it's actually costing you. So that's where we came up with that $40,000 to $45,000 net revenue figure. Clearly, at $100,000, if it's going to save you over 10 grand in tax, if you're not incorporating, you're hitting these milestones at 100 grand average per year in net profit, you're leaving a lot of money on the table. Have this conversation, this consultation with a tax advisor, whether it's with us or whether it's with somebody who you currently use. Open up this conversation. And if you are hitting these numbers and you go to a tax advisor and they tell you, no, it's not worth incorporating, it's not going to save you any money, jump ship, come and work with us, go and work with anybody else, because I've been doing this almost 2 decades and these numbers don't lie. Numbers don't lie, right? This is the amount of tax that you could be saving per year. And over a 5-year period, let's say that you're hitting these net revenue figures over a 5-year period, that's $50,000+ in tax savings for yourself, simply over a five-year period. So you can imagine if you multiply that by 5, 10, 15, 20 years, the code in almost 2 decades has never changed for this reasonable salary compensation plan, and utilizing the subchapter S corporation to retain wealth and not overspend with Uncle Sam and the state agencies. So once again, just to break this down, sole proprietorship, S corporation, if we're issuing a 40% reasonable salary, nothing changes for federal and state income tax purposes, but look at that self-employment tax number. As an S corporation, you're dropping your overall tax rate by about $9,200. And even at $50,000 of net profit, it's saving you just in Social Security and Medicare tax about $4,500, $4,600 in overall tax. Once again, this is not including the rent back of the in-home office and deducting all the legal and professional fees for payroll processing, tax preparation, all of that stuff. So there's a couple other things that need to be taken into account, but you see the numbers don't lie. All right. So I want to leave you with that. Just as a reminder, as self-employed individuals starting in 2018, there is something currently built into the Internal Revenue Code called QBI. QBI, no, it is not a new variant of COVID. It's not the nasty sinus and allergy kind of situation that we're having. It doesn't mean anything else but a tax code change. QBI stands for Qualified Business Income. And the QBI deduction that started in 2018 is essentially a 20% tax-free credit on your return. Now, how the heck does this work? Let's say that you are married filing joint, and I'll use a scenario, just an example really quick to show you how this all works. Let's say that my wife and I are both self-employed. And my wife brings in 150 grand in net profit. I bring in 150 grand in net profit. So collectively, let's say our taxable income, all self-employed income, adds up to be about $300,000. Well, if you follow the married filing joint column to the left, the blue column, we are trying to keep the taxpayer or ourselves, my spouse and I, under $329,800. Well, 300 grand is below the $329,800. So we would qualify at that point for this QBI deduction. Now, what is the QBI deduction? It is 20% of all of your qualified business income that pays absolutely nothing in federal income tax. So on 300,000 between myself and my wife, and if that's all qualified business income, 20% of 300 grand is $60,000. That means that $60,000 of our 2023 revenue pays zero federal income tax. This has been around since 2018. If you're single, head of household, married, filing separate, you're going to follow the red column. And so your taxable income needs to be under $164,900. And this is taxable income. This is not your gross income. This is your taxable income. So if you're sitting slightly above one of these two thresholds and you have the ability to max out a 401k contribution or an IRA contribution, or go out and purchase a company asset like a vehicle and take bonus depreciation to help you drop yourself below one of these two thresholds, not only are you getting the great value of the deduction in the retirement contribution or the vehicle purchase, but it's also dropping you below the threshold to qualify for 20% of your QBI qualified business income tax-free. This all comes for a full circle to the importance of tax planning. Tax season is always a busy time for us tax advisors, but I'd say that probably another part of the year is even more busy for us. That's the fourth quarter of every year. So September, October, November, and December is probably just as busy, if not busier, than tax season because we're closing out the calendar year. We want to sit down with our clients, map out year-to-date net income, map out year-to-date expenses, map out everything year-to-date, figure out the number that we're working with, and then send our clients out of that consultation back into the wild to go ahead and reinvest their profit back into infrastructure. But at least we get a snapshot in time of let's say in October, if they didn't spend a single dime between October and December 31st and there was no revenue coming in, we'd already know what their 2023 tax return looks like because we have all the year-to-date information. Having that information at your fingertips, that is a power position for you as a business owner. Number one rule in business, by the way, is pay your employees. But number two rule in business is reinvest profit back into infrastructure. Rule number three in business is exercise rule number two to pay as little tax as possible, right? So by exercising rule number two and reinvesting your profit back into your business, you are essentially in turn allowing yourself to pay less income tax because you're deducting all of that reinvested income into your business. So by planning ahead and knowing what that net revenue figure is, not only is it going to give you an idea of what you'll owe at the end of the year or in tax season next year, but it's also going to allow you to control some of the credits that you might be able to apply for. This in particular is 20% of your QBI tax-free. It is one of the greatest benefits built into the Internal Revenue Code in my 2-decade career, probably in the 50-year career that Bob Hall has had in the tax industry. So just keep this in mind. This has been around since 2018. We do have the Q&A box open. I'm going to get to that. I see one question already in there. I'm going to end on this screen. This is for the free consultation. If you just want to text Robert Hall to the number 72,000, that automatically submits your information for a free consultation. There's a link that you'll click, plug in your number and your phone number and your name, and then our office will reach out to you and get you all scheduled with a free consultation. I suggest getting copies of 2022's return and 2021's return. If you're on extension, get 2021 and 2020. Send those over prior to your new client consultation time so that we have time to review those returns. And then during that 30-minute, either in person or over the phone consultation, we'll be able to advise moving forward how we would transition you into a Robert Hall client. And then also, if anything needs to be corrected on those previous year's returns, we'll go ahead and amend those returns at the same time. If anything, if you're not looking for tax advice, if you're not looking to onboard, at least submit your information to be added to the webinar list. All of our education is free. Most of it is taught by me. We do have another public speaker here, Nicole. She's fantastic. But all of our educational webinars are free. So if anything, sign up for this just to be put on that email blast, that email list. If you don't want to text, you can scan that QR code at the bottom right part of the screen. That will also prompt you to sign up for that free consultation or be added to our webinar list. All right, let's go over to Q&A. Rosie, thank you so much for your question. If you just paid yourself through the S Corp and not using W-2 form, is it better to have a W-2 or not? If so, what is the difference when having a W-2 versus not when using an S Corp? So I've run into this situation a couple times where people forget to do year-end planning, where they forget to run a payroll for themselves. You still should actually compensate yourself on paper as not a W-2, but as a paid shareholder of the business. So let's say December 31st is past. It's too late to run a W-2 for 2022. We get ready to file your 2022 S Corp today, let's say, and you didn't run a W-2 last year. On the tax return, I will look at what your net profit is, and I will calculate what 35 to 40% of that net profit is and I will put that number into officer compensation. And the reason why we want to do that is because if you don't compensate yourself as a W-2 wage earner, you don't qualify for QBI. That's one of the big kind of catches here, is that you have to compensate yourself a W-2 out of the S corporation in order for that K1, this flow through profit, to qualify for that 20% net revenue credit. If you're a corporation, if you're a sole proprietorship, you don't have to compensate yourself because you're self-employed. You're not an employee of a corporation at that point. So the game is a little different as a sole proprietorship. As an S corporation, it's damage control at that point, where we would compensate you on the tax return, but only because you didn't run a W-2. But then during this year, when we sit down for the consultation, I will advise that client, hey, we need to get a hold of you prior to the end of the year to run a formal W-2, because in theory, the code, not in theory, but the code specifically states that if you are an 1120S corporation and if you have any sort of profit, if you have a loss, you don't have to pay yourself. You can't squeeze juice from a turnip, right? But if you have any sort of profit, you are required to take a reasonable compensation salary from the business, and that would be via W-2, okay? Roselia, thanks for the question again. So if you open up an S Corp and can pay yourself salary the first couple of years, is that okay? And I assume that your question is you can't pay yourself a salary. That's completely fine. You do not have to pay yourself a salary unless there is a significant profit through your business. I'd say profit over $10,000, right? So after all of your expenses are taken into account, if you've got a $10,000 profit through the business, then technically you have to compensate yourself at least $3,500 to $4,000 on W-2. Remember, though, you shouldn't be an S corporation if your net profit is only 10 grand. Right? So if you preemptively incorporated yourself, unfortunately at 10 grand of net profit, even though you're required to issue yourself a salary, the cost of filing as a corporation is going to be a little bit greater than what it's saving you. It's not going to be quite a break even, but at $10,000 in net profit, it wouldn't save you more than it's costing you. So it's okay if you don't pay yourself a salary in the first couple of years if you have a break even scenario or any profit below $10,000 or a loss. But if you've got $10,000 or more in profit, you got to compensate yourself. You have to be in compliance with the Internal Revenue Code. Okay. Ivan, thanks for the question. Do you have email address for a general question regarding changing from sole proprietor to LLC? So one of the things about being an enrolled agent, a licensed advisor under the Internal Revenue Service and filing tax returns, you have to engage in our services. So if you're not currently a client of Robert Hall's, the way that you engage in our service is by submitting your information for the free consultation. At that point, then one of our senior advisors will give you their email, and then you can communicate back and forth with the senior advisor. But unfortunately, we can't give our information out and advise you from a tax perspective without you engaging in our services first. It's part of a rule book called Circular 230. Circular 230 is the handbook and the rule book for enrolled agents. Even CPAs have this little rule book that they have to follow. So unfortunately, I can't give you the email. You'd have to engage in our services through the free consult. Let's see, Roselia. So you should start with an LLC. Correct. So you would start off as an LLC for the liability protection purposes. If you want that benefit, it's still going to cost you that annual $800 filing fee per year with the state of California, but at least you have great liability protection. Once you hit that net revenue milestone of $40,000 to $45,000 per year, that's when we take the LLC and we convert it into an S corporation. And then you start reasonably compensating yourself as a W-2, so on and so forth. But yes, there is very much a time frame and steps that you need to take in order of occurrence, kind of dominoes that have to fall first in order for you to hit that milestone net revenue reasonable compensation level. Okay. Magali, thank you so much for the question. Would my Social Security number benefits be affected if I pay myself as a W-2 employee? So if you are collecting Social Security right now, the only thing that compensating yourself as W-2 would do is paying more into Social Security. So it wouldn't actually reduce your benefits. It would be adding into your pot of benefits, so to speak. Once you hit a certain age, and once again, I'm not a Social Security professional here, but I would have to look up the chart. I believe that if you are collecting Social Security early, then yes. If you go back to work, they would reduce your benefits because you're actually earning wages and you're paying into Social Security. But once you reach full Social Security retirement age, and don't quote me on this, I think it's age 62. I think I'd have to check on that, double check on that. But I think at age 62, you can work. and still collect your full Social Security benefit. And even though you're paying back into Social Security, it will not reduce the benefit that you're currently collecting. So there are age requirements and age limitations that you need to be aware of, but I do not believe that if you are at full Social Security retirement age, that you working will affect anything that you're currently collecting. If that's the question, I think I answered your question on that one. If there are any more questions, I'd be more than happy to answer them. Once again, this is the best way to engage in our firm's services. This is the best way to get all of the questions answered. We have plenty of openings. It's May 17th, so a number of our senior advisors are readily available to answer your questions. But this is the best way to communicate with our firm, to get on the calendar, to get those questions answered. One more question came in here. Oh, no, that was just a thank you. You're very welcome. Not a problem. If there are no other questions, though, like I said, take advantage of this free consultation. It is just it's a wonderful thing. We've been offering the free consultation for over a decade now, I think. And I remember like it was yesterday, us having to fight tooth and nail to actually start offering a free consultation as a service. But it has been just incredibly beneficial for our clients, not only our current clients, but future clients. And, I remember having consultations with clients 1 year, and then 3 or 4 years down the road, they were still using their other tax preparer. Then that tax preparer retires, and they had already had a consultation with us. So it was an easy transition over to Robert Hall and Associates. A lot of accountants retired during the pandemic, a lot of kind of like single owner accounting firms. So our firm grew 35% during the pandemic. Once again, we service all 50 states. We've got 55 employees, so we're not a small operation by any means. That means that we are power by numbers. We work as on a team kind of structure where you'll have your tax advisor, the one that does tax returns for you and everything. But if you need copies of tax returns, if you need notices corresponded to with the IRS, if you need audit representation, we have teams in Robert Hall that handle all of that. So instead of dealing with one person who's bogged down with all of this work and, doesn't have the ability to answer a question when you call in, we have teams that are readily available to answer these questions, which makes us a very unique operation in not only California, but in the US. We are, I believe, one of, if not the largest enrolled agents accounting firm on the West Coast. And we have over 10,000, actually, I think over 11,000 filings that we service per year. So we do see a lot here at our firm. Great. 2 other questions. Where do I sign up for the free training you mentioned? So once again, you can either, okay. So if you don't want to text Robert Hall to the number 72,000 that you see here on the screen, or if you don't want to scan the QR code, you can email info. Let me put this in the chat box. You can email info to everyone. Here we go. info@roberthalltaxes.com. You can email that email and then we can respond with you via email. If you don't want to do it this way, the QR code or the texting option, or you can email, this is also, even though it says my name on it, this is also an email for the marketing department. And it's just my full name, Tony Watson @roberthalltaxes.com. That does not go to me, by the way. That goes to our marketing team. They set you up with a free consultation. They'll call you. They'll look at the schedule, see what works for you. And that's the best way to sign up, not only for the training, the seminars and the webinars, but that's also to potentially set up for the free consultation. But if you don't want the free consultation, at least get on our webinar e-blast list. Like I said, we do 140 events on a yearly basis. So a lot of free education here at Robert Hall. What is the average cost for payroll, especially when we decide to start with an S corporation? So payroll costs, we use Paychex for most payroll servicing. Paychex, I believe, for an annual salary payroll run, it's like $800, $700 to $800, I believe, which is dollar for dollar tax deductible through the S corporation. But once again, if you're not hitting these milestones, I don't want it to cost you more than it's saving you. At $40,000 to $45,000 in net profit, shoot, I mean, you're looking at quite a bit of tax savings, about $9,200 in overall tax savings. So, I mean, I'm sorry, not $9,200 on the 45,000. That's at about $5,000 to $5,500 in tax savings. But once again, if it costs you $2,500, max $3,000, let's say, to operate as a corporation, but it's saving you $5,000, you're still coming out ahead $2,000 in tax savings. That's what the costs I don't want people to get caught up on. It's all about whether or not it makes sense for you specifically. If it doesn't make sense, we do not want to overpromise, underdeliver. If it doesn't make sense for you, we're going to tell you, let's hold off on incorporating. Let's wait until next year. We'll revisit the conversation, right? So payroll is about $800. With an S corporation, do we need to have payroll? Yes. So I think I already answered this earlier. With an S corporation, you are required to pay yourself a salary, a reasonable compensation salary, if your net profit is anywhere above $10,000. If your net profit is under $10,000, number one, you probably shouldn't be an S corporation to begin with because your net profit is so low. But the government doesn't want you to squeeze juice from a turnip, right? They don't want to force you to pay Social Security and Medicare tax if your net profit is already pretty low. It's only when you hit about 10,000 plus in net profit where the government's going to require you to issue a 35 to 40% net revenue or a net 35 to 40% reasonable salary. Okay. So yes, under an S corporation, you are required to. If you didn't issue a salary, don't worry. There's a little bit of a damage control scenario that we can apply to the return. But the following year, we absolutely need to file payroll for you or get you on that year-end planning schedule to where we can meet prior to the end of the year and calculate what your W-2 compensation should be. Okay. That I think covers everything. I think we're getting towards the end of our time here. You have our contact information. You've got the way to communicate with us for the free consultation, the webinar division. You know, this is the best way, once again, to communicate with Robert Hall right out the gate. Once you become a client of ours, you have your accountant's email. You have, you know, a number of resources here at Robert Hall. We do offer something called a tax maintenance program as well, which allows you to have up to 3 15 to 30-minute phone calls with your consultant for free each year without having any consultation rates or anything apply. Emails, like I said, are normally free. Sometimes I get emails from clients that are like 5 paragraphs long. If they're looking for calculations on 1031 exchanges, calculations on reasonable salaries and whatnot, I can't do that all in an email because it's too much information. And basically, to be real transparent, it's intellectual property that we have as tax advisors to do in an email. So I normally suggest for people to set up a consultation with their tax advisors if the questions are 5 paragraphs long. If you've got a question about what is deductible, I mean, shoot, yeah, I respond 50, 60 emails a day. Just, hey, I'm out buying a computer. Should I run it through my business? Absolutely. Hey, I'm trying to lease or purchase a car. Which one is a greater benefit for me? I think purchasing would be better because of bonus depreciation. Oh, well, I'm looking to actually get a sports car. Well, leasing at that point would be better rather than purchasing. So I get these questions a lot. Our advisors get these questions a lot. Those are the ones that we can respond to pretty quickly. But if you are looking to solve the world's issues in one email, and it's going to take 30, 40 minutes just to respond to the email questions, we normally suggest to set up a consultation for all of that. So you have our contact information. We look forward to connecting with you. I don't see any other questions in the Q&A column. Thank you so much for spending time with us today. And we look forward to hearing from you. RHA is readily available to service and assist in any way we can. All right. Everyone stay safe out there. Have a wonderful week and weekend, and we will be chatting with you soon. Have a great day.